Between February 2nd and March 2nd, mortgage interest rates went through the roof. And you've probably heard a lot of people saying this.
See, I told you the market was going to go bad, man.
Yeah, so my calculations insisted that interest rates would eventually go too high and hurt the market. I knew this was coming.
Hello and welcome back. Between February 2nd and March 2nd, we saw a significant increase in mortgage interest rates from 5.99%, the lowest they'd been for a while, up to 7.1% on March 2nd. The question is, will those high interest rates persist? We'll take a look at that, and we're also going to look at the Phoenix market to find out what's going on there. You might be surprised at what's happening. First thing we want to think about is, why did interest rates go up so quickly in just a month? Two things happened. Two reports came out that
really scared the market.
Number one, jobs in February showed an increase of 517,000. The second thing that happened was the consumer price index didn't drop as much, inflation in other words, didn't drop as much as people thought. It went from 6.5 to 6.4%. They were expecting 6.2%. And we can see the impact it's had on the marketplace. Now, the 10-year Treasury, I talked about in my past videos, is an important barometer of what's going to happen with mortgage interest rates. And those 10-year Treasury prices are impacted by two things primarily. Number one, the health of the economy, and number two, inflation. So where do we think inflation is going to go in March, April, and May? Well, we have some indicators out there already of what may happen. Number one, when we think about the jobs market, and we'll get a report on unemployment on March 10th, Friday, March 10th, that 517,000 jobs created weren't really 517,000 new jobs. When we reach the end of the holiday season, during the holidays, employers hire on temporary workers. And at the end of that period of time, they tend to let them go. They're part-time, they don't need them anymore. And so we see 3 million jobs usually drop off. But this time, we only saw 2.5 million drop off. So that difference was actually counted in as a seasonally adjusted employment number for the February numbers. So did we really create 517,000 new jobs? No, we really didn't. What they did announce was that unemployment went from 3.5% to 3.4% seasonally adjusted. So if they created 500,000 jobs, why did it only move 0.1%? Because they know it wasn't really an increase of 517,000 jobs. The real unemployment number, not seasonally adjusted, is actually 3.9%. And we can see that here on the Bureau of Labor Statistics charts. So that number nevertheless scared the stock market. Along with the CPI, which we'll see in the stock market charts here. February 3rd, we get 517,000 jobs. The market trundles along for a little bit. I think they know that those numbers are a little cooked. But on February 14th, we get a CPI that only drops 0.1 from 6.5 to 6.4. And now they think the Federal Reserve is going to raise interest rates again. And they're not going to probably do 25 basis points. They're probably going to go back to 50 basis points. That takes money out of the economy, makes it harder to do business, harder to get loans. And so the market started to decline. All the way up until last Friday, when we received some good returns, some good market reports from individual companies showing that they had made money in the last quarter. And the 10-year Treasury dropped from the high of over 4 down into the 3.95 area. Now, that's still way too high, because if you add even 3% to that, you're still near 7%. And that's too expensive to buy a house. And that makes it difficult for people to get out there and even look for a house. Is that going to continue? Probably not. On March 10th, Friday, March 10th, we're going to find out about the unemployment rate. And it probably shouldn't drop much, because that seasonally adjusted number is gone. It's out of the way. We may see unemployment actually go up. And if it does, the market will probably react positively. Yep, they'll react positively to unemployment going up, because now the Fed becomes less of a threat. On March 14th, we'll get the consumer price index. That may be a little bit trickier. And I say that because there are four main things that the consumer price index really focused on the last few months. That is shelter, food, gasoline, and natural gas. And by this chart, I can show you that the price of gasoline has gone up just slightly. But the price of gasoline impacts those other three items. So the price of gasoline goes up, costs more money to ship food around, costs more money to ship supplies, to build new homes, to build new shelter. And if you're not drilling, you're probably not getting as much natural gas as you need to lower the price of natural gas. Natural gas is often a byproduct of drilling for oil. There'll be pockets of natural gas right above the oil field. They can draw that out as they're drawing the oil. But first they have to drill. And oil companies are not really in the mood to drill because they've been told they're going to be shut down in 10 years anyway. So why sink a whole bunch of new wells? Or why build a refinery? And that's really the bigger problem we have. We haven't built a refinery in a couple decades here. So we can pump all the oil we want, but if we can't refine it, we can't turn it into gasoline, diesel, all the other products that we use petroleum for. And just about everything you touch every day is made from petroleum in one way or the other. Look it up, Google it. So with the price of gasoline going up slightly in February, when we get that March report on the CPI on inflation, that might counteract a good jobs report. And by good, I mean unemployment going up slightly and changing the market, actually making the market react positively, and the 10-year Treasury coming down so that you can afford to buy a home. Now, if you think gasoline really doesn't have that much impact on inflation, let me show you two charts. Here's the one for gasoline prices, and I'm going to overlay the inflation rate over the last couple years. Now remember, back in November of 2020, gasoline was $2.09 per gallon, and it began to go up almost immediately after the election. And currently in Phoenix we're at $3.79, so $1.70 more, almost double the cost at the beginning of this chart. And you can see inflation pretty much correlates to the cost of fuel. You know, we're a big country. We need energy to do everything in the...
If we were a little tiny country,
we wouldn't need that much gasoline. I mean, we could use rail a lot easier. The distance traveled isn't as far, so you don't burn as much fuel. But we're a huge country, the third largest country in the world. So it takes a lot to move things around this country. And so gasoline is going to be built into the price of everything that we do, everything that we buy. And we can see that by this chart. So our next question becomes, let's say we get a good jobs report but a bad consumer price index. What happens then? Well, we hope as we get through spring and the country heats up, we get through winter, then we're going to start seeing the expenditure of gasoline and fuel oil for heating decline. And so we should have higher supplies, less demand, and the price of gasoline will come down, which means the consumer price index should come down. If that happens in April, or even in March, and we get that report in April, and we continue with the unemployment that the Fed is trying to create by raising interest rates, then we could see the 10-year Treasury start to drop again, and mortgage interest rates drop even further. By May, we may be in the 5s. And if we're in the 5s in May, I think we're going to see an explosion of selling in different markets. Maybe not your market, but I'll give you an example of what Phoenix is looking like right now. This is the Cromford report. And in the Cromford report, I'm comparing February 2nd and March 2nd. The two dates I gave you earlier were mortgage interest rates were 5.99% and then 7.1%. If you aren't familiar with my other videos, the Cromford report, if the range or the number associated with a city is between 90 and 110, that's pretty much a balanced market. Buyers don't have an advantage and sellers don't have an advantage. But above 110, sellers have an advantage, and below 90, buyers have an advantage. So if you look at these two charts, you can see some pretty significant changes that have gone on. On February 2nd, the highest rated area we had was Fountain Hills with 161.5 on the Cromford Market Index. So a pretty strong seller's market. If you look on March 2nd, we've had Chandler move up to 190. Very hot, a 21% change from February. Chandler overtook Fountain Hills. Fountain Hills has been on top for quite a while. But then we see some outlying areas like Glendale and Avondale, suburbs of Phoenix, really picking up the pace. Glendale moved up 4 spots from 7 to 3rd with a 25% increase in their market index. At the same time, at the bottom, we still have Queen Creek, Maricopa, and Buckeye on both charts. And Goodyear still, while Goodyear was in a seller's market, it is now more in a balanced market. Surprise has moved up from 95 to 102, putting it more firmly into a balanced market. And Peoria, which was straight across 100 in February, is now 122.5, meaning it has moved into a seller's market. Phoenix at the start of the year was already 100,000 homes short, and every year 80 to 100,000 people move here. With all the businesses coming, particularly the chip industry moving to Phoenix, they're going to need a lot of homes. New home builders aren't pulling as many single-family home permits. Now they're pulling multi-family home permits, which means they're going to turn people into renters. And that's sort of a shame. If you're looking for a home, keep watching this market over, particularly in April and May. And if you see the interest rates drop, jump on it. Find yourself a realtor early. You don't have to buy right now, but at least you can be in discussions with a realtor who understands the market, put you in touch with a lender, and when you see those interest rates drop, jump on them before they go back up again. We've heard all the doom and gloom sayers about how the market's going to crash.
Yeah, man, like, I told you this was in a good market. Like, I knew it was going to go a little sideways.
And in some parts of the country in May, in Phoenix, it's tough to see that. Just showing what's going on in Phoenix right now, even with high interest rates, and with the spring selling season coming up and people wanting to move here. I don't know. I just can't see it. Maybe it'll happen. Maybe I'm completely wrong. Unless something catastrophic happens, it's going to be tough to drop the Phoenix market down, 20, 30% like people have been saying. If you have any questions, if you want to go over these numbers, if you want to talk about the marketplace in Phoenix and the surrounding area, please feel free to give me a call. I really specialize in the West Valley. If you need someone in the East Valley, I can find someone for you there. I know a lot of different agents in this marketplace, and we'll help you find the place that you really want, put you in a position and prime you to be ready to jump when those rates hit where you need them to be, or show you how you can get seller concessions in today's market to help buy down the rate right now. But again, if you have any questions about any of this, I'm always available to help you. Just give me a ring.